Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Christopher Verrone is with us, working with Jason Trennett at Strategas. He is definitive on trend-based technical analysis. As many of you know, I'm comfortable with that versus the catching a knife in the dark approach. Chris, I got 8 ways to go here, but I got to first go to price up, yield down. Is it a critical pro level that the 10-year yield is through 4%?
I don't think it is. I mean, let's just look back at the last 3 years. We've effectively been between 375 and 450 on 10-year yields for 3 years. We've had this very unsatisfying call on yields that the only correct call is no call. And I'm kind of still in that camp here. You know, under 375, my antenna would start to go up more that, maybe something's really starting to change. But, frankly, Tom, it's more curve shape right now than it is anything. And you have this little subtle flattener.
It's Friday.
Yeah.
Okay, we're going into the weekend. Sweeney's flying to California. You're supposed to say, OMG, it's like a huge deal. Paul, pick it up.
So we've seen, Chris, a rotation in the equity markets here. The growth is definitely taking it on the chin a little bit here. Some of the software stocks and things like that. Some of the industrials and small mid caps have been working here. Is that a short-term trade or is that something bigger, do you think?
I think this is a big, right? Of course, we know that we don't know, right? But our hunch is that this is a big deal. And it didn't begin 4 weeks ago or 8 weeks ago. I mean, this began back in September, October, when you look at when equal weight started to really outperform the Qs.
Yeah,
I think this is early days in what is a trend that will define not just the remainder of the year, but kind of the years to come here. I think this is the transition, and our call has been the transition from kind of the speculative corners of the market to the real economy or the old economy. I think that's well underway. It's ongoing, and I would expect it to continue moving forward.
You were pretty much through the earnings. Most of the S&P 500 companies have reported earnings. What have you seen? Is it enough to support this market here, do you think?
Well, I think earnings are growing in something like 12-13% year over year here. When you look at yesterday's response to NVIDIA, I think even more evidence in this regard. I mean, stock closed on the lows, right, down 5 or 6%. Advancers overwhelmed decliners yesterday, more stocks up than down, despite NASDAQ down nearly 2%. Fourth day this year where you've had the NASDAQ down at least 1%, yet more stocks up than down. That only happened 3 times all of last year. So you kind of see this average stock over the index continuing to proliferate.
Chris's people, folks, sent me the Strategas deck on all this. And we could literally talk to him for 3 hours, ending with the jump move we see in Chinese yuan now. Let's stay on software stocks because that's what everybody's focused on. You talk about a high volume reversal. Is it catharsis where you load the boat?
I don't think you load the boat. I think you cover your shorts if you're on the short side of the story here. And, when you look at what tends to show up in the ballpark of a bottom, one of the features is this indiscriminate selling and the acceptance of narrative, right? So you have indiscriminate selling the last couple of weeks in software. I think 80% of them made a new low, only 5% above the 200-day moving average. And then suddenly this agreed upon narrative of why they're all down. That generally is found late in the decline, not early in the decline. So I would be covering shorts if on the short side of the boat here. I might position tactically for some type of a bounce, but has the trend changed? No.
Good morning across the nation. Chris Verrone with us. We're going to continue with a good conversation. I got to drop in some of the data points. Paul, Brent crude 72.25, up way over a stick, 72.25 on global oil.
Torsten Slok, our good friend over at Apollo, out with a note this morning. The average daily U.S. equity market turnover now exceeds $1 trillion, driven by higher retail participation, more high-frequency trading, and recent tech market volatility. What does that tell you when you're seeing, just trading volumes pick up? I mean, people are in this market on both sides of the trade, it seems.
Well, Torsten does great work. He's a close friend. I think the point is well took here, that there is a lot going on under the surface for an index that really has gone nowhere for 6 months. I mean, S&P is in one of the narrowest 6 month ranges that we've seen in a long time, call it between 6,700 and 7,000. It doesn't tell half the story of what's played out under the surface here. I think the question here as we move forward, with 10-year yields back to the lower end of the range, can lower bond yields recatalyze the more cyclical corners of the market? And if they can't, then what is the message the market's attempting to send us, right? You started the year with all these anticipations and all this hope of some big cyclical recovery. If the cyclicals can't going, when do we start to get more worried about that?
What does Dan Clifton say about that? At Strategas, you've got public policy down cold. Is this a nervous market looking forward to a nervous public policy?
Yeah, I think if Dan was sitting here and we were with each other yesterday, we were talking about this idea.
You're on speaking terms with him?
We are every day. Hard to believe. Cool. We were talking about this idea of that public policy, fiscal policy, is really in the gun it mode here over the next number of months. So if the market's going to respect that, I think it's time we start seeing the discretionary names turn back up. I think it's time that we see a lot of those pro-cyclical stocks really reclaim the baton of leadership moving forward.
Right. We're going to go to London the end of this hour for Global Wall Street, a brief on this MFS uproar in London. Paul?
U.S. versus rest of the world. We saw in 2025, while the U.S. equity indices did very well, many of the stock markets around the world did even better, and that's continuing in this year. How do you think about the U.S. allocation versus rest of the world here? So
I think that trend that began really in late 2024 continues here and continues in a very big way. If you look at U.S. market cap as a share of global market cap, that peaked in the fourth quarter of 24. So we're almost 18 months into this transition. Put aside the dollar considerations for a moment and just look in the month of February. You have new highs in almost every global market. Where do you not have a new high? Triple Qs, S&P, right? The price action is telling you the character of the global leadership has changed.
The character of your work is a logarithmic y-axis, very careful moving averages. I use what are called climate exponential. Chris uses something different. We all got our own way. And what I see in your charts, and you feature HSBC out of London on this, it's remarkable given the frantic nature how things are still on trend.
Yeah.
Have we broken trend? If somebody listening with a 401k, they're going home this weekend, they're worried that the Islanders beat the Montreal Canadiens in the last minute, should they be worried about trend in their retirement?
No trends have been broken here, or no trends of any significance kind of at the index level have been broken, particularly globally. I mean,
is that in the media? I think you're right. And the frenzy here is ridiculous. It's juvenile.
I think it's remarkable. When you look at all these things, there's almost this desire for some of these idiosyncratic episodes to become systemic. Like you can kind of sense it in the tone, particularly of the financial media here. Of course, both of you notwithstanding. It just gets this sense that there's this desire to almost repeat what we saw in 07, 08. Big differences here. I think number one, the bank stocks globally in, really by 06, we're starting to send a very ominous message. That's just not, look at these European banks, look at the Japanese banks, they're still very much in trend. And I think public credit, spreads are modestly wider here, but they're not exploding. I get the concern around private capital. I think there's more to that story than perhaps this kind of this kind of story that we're being told. Think about the financial deregulation aspect of this. If we're going to deregulate money center banks, why would I want to own an Apollo or a KKR or an Owl when I can own a Goldman or a Morgan Stanley or a Bank of America? I think that's part of the story here as well.
So you mentioned the spreads. They're widening, but they're not blowing out. And that's what we've heard from bond folks. And they're saying, if the tech companies want to issue more paper, we'll take it. So is the bond market, do they have a better handle on risk out there than maybe the equity markets do here?
I think the demand, particularly in the high yield quarter of the debt market, remains pretty remarkable. This stuff gets just absorbed almost immediately as it comes to market. I think it's why spreads, again, while modestly wider, are not really blowing out here. I think the more difficult question is when you look at the kind of arc of the leadership over the last number of months, with staples better, with healthcare, with utilities, is this the market messaging something more sinister from a defensive perspective is coming? I'm not quite there yet. I think healthcare, the narrative will become, hey, this is the beneficiary of AI. Look at all this drug discovery. That's where I think the puck is probably going on healthcare. Staples, for as good as they've been recently, actually have not turned in our work. They're still in a relative downtrend. And in the spirit of trend following, Tom, staples are still a relative laggard over the longer term in this market.
We're going to go here, but from the technical analysis that Chris and I do, folks, is trend-based versus catching the knife. And people love to try to catch the knife in the dark. How do you use moving averages? I see such a misuse. I'm nuts, folks, on the death cross and the life cross. What if it were going up? Is it what's it?
I don't know.
Birth cross? I don't know. How do you use moving averages?
Tom, you remember how your mom probably said nothing good happens after midnight? Well, in our world, nothing good happens below downward sloping moving averages, right? So if it's the 200-day moving average, downward sloping, we just don't play. And it's tempting to want to catch knives. Right. It's tempting to want to call lows. That's just not where the money's made in this business. The money's made in uptrends. The money is made both from a volatility adjusted perspective, owning things with upward sloping moving
Brilliant.
averages.
So let's get the Verrone Keene approach here and have you talk about the software stocks. The only way you can really make money, folks, on a risk adjusted basis is an up market, an up sector, and an up stock. Yep. If the software stocks is Microsoft, broken that maximum.
So if you look at a very long-term basis, Microsoft right now is hovering right near its upward sloping 200-week moving average. So this is kind of where the decline stopped both in 2022, where it stopped in 2018. So you're in the zone where if Microsoft is going to stabilize, it kind of has to happen here. That is very different than many of its peers. Workday, ServiceNow are in long-term downtrends.
But
Adobe,
those aren't
Salesforce.
peers to the cash flow of Microsoft.
In the spirit of the same group, I would be very skeptical of bounces in that other quality of stock.
I'll get one more in there, but the key thing Mr. Verrone said there, folks, is his unit base was weeks. Pros use weeks. Good morning, Louise Yamada. Paul Sweeney, one more with Christopher Verrone.
I'm looking at just the NASDAQ with the tech-heavy NASDAQ, and I type in the RSI function in the Bloomberg terminal. It says, that RSI function says we're oversold if the index is at 30. We're overbought if it's at 70. We're at 47, right smack in the middle for the NASDAQ. I don't know what to do here. I think tech traders don't know what to do here.
It's funny. We've joked about this before, Tom. I think overbought and oversold are the most misused terms in this business. Oversold's bearish. Overbought's bullish, right? Things that get overbought and can stay overbought are your best trends. Things that get oversold, no thanks.
Yep.
Particularly when you're oversold in weak trends. And you look at the NASDAQ right now, it's probably the weakest of the major trends. And it's in kind of no man's land from a momentum standpoint. I believe as of last night, only about 40% of the tech sector was above the 200-day moving average. I mean, that's a very difficult place to expect that you're going to make consistent returns. I want to fish where the fish are most abundant. That's not with 40% of issues above the 200-day.
Don't be a stranger. Bring in Jason Trennett as well. Christopher Verrone is with Strategas. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Speaking to her in the coming weeks here, particularly on Iran. So this is the way it works, folks. We have teams. Paul and I don't really have a job. We sort of saunter in and, hang out, get a coffee, make jokes. We have people that work definitive on this crisis in London are Scott Carpenter, Donald Griffin, and the leadership of Constantine Courcoulas. Constantine joins us off the desk at Queen Victoria Street this morning. He's in charge of distressed debt and cockroaches at Bloomberg Nationwide. Constantine, first of all, congratulations on the impact of your reporting worldwide. If we look at Market Financial Solutions Limited, is there contagion?
I mean, that's a big question. So far, we haven't seen any signs, although in the equity market, some of these lenders definitely took a hit. I think Jefferies was down as much as 10% yesterday because they're exposed to around 100 million to this entity. Apollo also down 5%. It had lent around 400 to this entity via its secured credit vehicle Atlas. So, there's already signs of jitters in the equity market, but not seeing this spreading to credit yet.
I've done my amateur work on their chief executive officer. Some reports he slipped to Dubai. Paresh Raja, I hope I'm pronouncing that correctly. Who is Paresh Raja?
Very good question. We don't know all that much about him. We have, Bloomberg, my colleagues have done an investigation on him back in 2024 and showed that a group of firms that had tied to him, including MFS and another entity, Zircon, lent money lent money in relation to property deals to a former land minister in Bangladesh. So yeah, the story kind of starts back there, but yeah, we don't know other than the fact that he is the sole owner and officer in the sprawling empire of MFS, and then this investigation back in 2024. Yeah, we don't know all that much about him, but that's something we're chasing.
Talk to us about Market Financial Solutions. Who are these people, and what part of the credit market do they play in?
So they're a niche market mortgage lender, I suppose. So they kind of step in where traditional banks won't, and they provide short-term sort of bridging loans or other complex structures to help facilitate, like maybe there's an entity that wants to sell a property and buy another, doesn't have the cash to do that immediately. That's what's called a bridging loan. So to finance this, they borrowed vast amounts of money from traditional lenders on Wall Street, and then they're tasked with collecting payments and servicing these loans in a sense. So that's the business model. But what turns out, the allegations are that a lot of this money that was supposed to be going back into the certain bank accounts went into other bank accounts. Right. The court documents so far show that there's around 200 million that kind of got channeled into the wrong place. And on top of that, and this is what makes it much more interesting, is that it appears, and the allegations are, that there's been some double pledging of collateral. So, yeah.
Constantine Courcoulas with us. We're going to continue with him with his public service to his Greece, working with us at Bloomberg News. And I said earlier, it was a joke, folks. He's not distressed debt and cockroach reporter. That was kidding as well. Constantine, how do you respond to James Dimon upset about the cockroaches? Mathematically, or as a former Greek finance horse, how do you respond to that?
I don't know if I'm in a position to respond to Jamie Dimon, but he does make a good point that, look, I think, the examples are adding up, right? First Brands, Tricolor, now this, right? So I feel that we're in the point in the cycle where, fraud is surfacing to the top, and people kind of pushed into corners of finance to get that extra return, and it's probably, in hindsight, looks like a bad idea for some.
And Paul, you turned to me and said, "What about Jeffries? What exactly. First Brands, Tricolor, and now this next thing."
Exactly. So, Constantine, I guess that kind of goes to the question of, do we put this in this? It's just a one-off idiosyncratic thing, or is there something more broader here that people are concerned about?
I think definitely. I think it's only how many examples do you need for it not to be considered a trend? That's my view. So, of course, they'll tell you that each instance is idiosyncratic and comes with its own parameters. But at the end of the day, these are the evidence is just there that
is the tilt here towards what I'm going to call executive fiction, delusion, fraud? Or is the tilt here to normative leverage market forces where, something goes wrong because of leverage?
It's where those two things intersect. It's when leverage is, when you use leverage and then you end up in a fraudulent situation, right? And then it's just the losses are just compounded.
Okay, we got to go. Constantine, we got to go here, and you got to get back to work. I mean, you haven't done. You've completely slacked off here this morning. What I want to know is, what's your biggest mystery as you publish to Monday morning?
Okay, so questions that I want to find out: where is Raja, and more about who he is, because the allegations in court were that he's skipped town. The other one is kind of how exactly this went down. What precipitated the blow up exactly? Right. And then obviously who else is involved, because I have a sense that there are some other names that we haven't unearthed yet.
Constantine, on behalf of all of Team Surveillance, thank you to your team for your reporting on this story. It's gone worldwide this morning. I really can't say enough about the work that we've seen off the derivatives desk at Bloomberg at Queen Victoria Street. Constantine Courcoulas with us. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is incredibly well timed. KPMG UK has done a survey of Europe, and of course, Yael Selfin joins us now. Yael, in America, all we're talking about is a lengthy Wall Street Journal article that says Paul Sweeney and Tom Keene are moving to Europe. So I want to personalize the KPMG 60,000-foot view. Yael, what is the Europe we're moving to? Whether we move to Portugal or Finland, we move to Wales, we move to Eastern Europe, Albania?
Sure.
Albania? What's the Europe, Yael, that we're moving to?
Well, first of all, welcome. We'll be happy to have you.
Thank you.
And I think Europe is very diverse. Yeah, I mean, you could say the US is relatively diverse if you look at different states, but when it comes to Europe, there's, as you say, there's a lot of different parts there. And I think generally there's quite a few opportunities. It really depends on what you're after.
Yeah, we saw about this time last year when President Trump initiated some of his tariffs, that we saw Europe step up here, and we saw a number of countries saying, okay, we get the message. We're going to start investing in our military, in our infrastructure, Germany in particular, making some big commitments. Is that something Europe can really do over the intermediate to long term?
Well, I mean, I think there's a few things here. One is, what would you really want Europe to invest in? I'd say defense is probably necessary, but if we can be as forward-looking as possible and try and invest in the things that will actually help our defense, as well as potentially more be of dual usage and help us with our productivity and other things, that's even better. So trying to figure that out is important. Also, Europe really want to try and produce as much as possible of it in Europe. And we probably as a whole don't have the capabilities at the moment. So there's a big theme of ramping up capabilities. Well, I mean, but first of all, you need to understand what it is that you want to produce.
Okay, yeah, this is in your KPMG study, you have nominal GDP. Just as a quick sum, it's maybe 4%. 4.2%, or maybe, dare I say, nominal GDP, the animal spirit of the economy, is sub 3%. Over here, that's a depression. Can Europe accept that tepid growth, or is there finally a behavioral motivation to be more Anglo-American?
Very good question. So I think there's two things here. One is we've had much weaker productivity in Europe than in the US. Some of it, I'd say, you can potentially change. There's definitely things that Europe can do better and is striving to do a bit better, but Europe generally is slow. I mean, if you look at the European Union, we have 27 countries. It's not that easy to bring them all together.
Yeah, stop. Yeah, it's not slow. It's a land of the 3-hour lunch. I've lived it in Frankfurt. Yeah, is AI going to speed things up for you? Is AI in Helsinki or AI in Paul Sweeney's Albania? Is it going to get it done?
Okay, there's AI, but also you need to think about what you're trying to achieve. There's also about things about quality of life, equality. There's other goals that Europeans have that America doesn't necessarily put as a forefront. And I'm not sure that is going to change as much. I think different priorities in Europe, and that's partially why they prioritize other things, and growth is not always the first priority.
Yeah,
AI will help. I think AI will help, but also it's not going to work the same way as in the US because you don't have the initial technology.
Yeah, what's the thinking now? Again, a year after President Trump began his tariff campaign, What's the thinking in Europe about the ability to partner with the U.S., to trade with the U.S.? Where are we with that thinking?
Well, US is still an incredibly important market for Europe and a partner across different, initiatives. But there's definitely a recognition that you can rely less on US to help in terms of when you look at defense, for example, but also you can rely less on the US as a market, given that policies change all the time.
Yael, you were at UCL and LSE. You got prodigious European chops. We've got to run to our next guest. I got 6 people telling me I got to get to them. Yael Selfin, as simply as I can, are Americans welcome in Europe?
Yes, they are.
That's good to know. You're over there all the time.
I'm loving it.
They love you over there.
I mean, just to finish this up, Yael, I go to Paris and I'm in a Disneyland tourist center of 3 arrondissements. There's a whole nother Paris out there I never see. Describe that tension between the real Paris and the tourist Paris of Tom Keene.
Europe has many challenges, and they need to try and overcome them. One way of trying to overcome them is by increasing growth and potentially, but also giving more people the opportunity to benefit from that growth. I think this is a similar issue to what we have in the US. It's not different at all. Okay. You have different worlds in the US as well.
Don't be a stranger. This has been fabulous. Yael Selfin, thank you so much. With the European report out of KPMG in the United Kingdom. Thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Rohit Chopra joins us from Lazard Asset Management, really to do a brief here on EM. But I got to go, you're at NYU, you're at LSE, and all of us study the history of the shadows that are out there. We are greeted this morning, and folks, our lead reporter on this will be on with us in 20 minutes. MFS in London, Mr. Diamond would say it's another cockroach. Are you and the broader team at Lazard, are you worried about the shadows of manufactured leverage, manufactured private credit?
So I think the most important thing, and Peter at Lazard, our CEO, talks about the context of contextual alpha and understanding the impact of events like that are unfolding right now, and how does that impact the broader context? So as an emerging market investor, we understand the cost of capital is born here in the U.S. and understanding that context around the geopolitics, where inflation expectations are. When I see that kind of context playing out in emerging markets, we're really constructive, the asset class. We see positive real rates. We see that liquidity measure are better. Quite frankly, the banking systems across most of the emerging markets are very traditional in nature. We don't have a lot in terms of private credit and non-banking financial companies.
We've really seen emerging markets perform so well over the last year plus. How much of that has been the weakness of the U.S. dollar versus maybe improving earnings, just better business prospects, geopolitics in general?
So, Paul, I think what's really exciting is that emerging markets just finished 10 years of famine, and we're in an 18-month period where EM is kind of getting a little bit of its mojo back. What's really important is that this is not just purely on weaker dollar, which obviously plays an important role in terms of global stimulus because long-term liabilities are denominated in dollars. But importantly, there's foundational change. Emerging markets is no longer the monolithic story of the past. We have AI opportunities that are taking place. I mean, as we know, many leading semiconductor companies, Korea, for example, is up 50% year to date. They're a key component of that. And at the same time, the debate around AI and disruption is impacting some of the service areas.
Should we do a victory lap on this?
Sure.
Rohit was way out front on this.
Yep.
I mean, you were in here months and months and quarters ago saying this is different. Why is Korea tripled?
Yeah, good question.
It's a couple of things. First of all, the local populace are equity owners of their companies, right? So they essentially are greater participation. We're seeing their flows picking up. We're seeing corporate governance reform. They just announced this week plans to improve treasury shares in terms of cancellations. And then the most important aspect is the focus on R&D and investment. In Korea, we've seen this development, particularly around memory, which has really helped the leading memory companies that are key components of high bandwidth memory that goes into our AI servers today. The other aspect, which I think people are getting excited about, is this aspect of robotics and humanoids. And you guys had an interesting piece yesterday looking at the Atlas robot by the Hyundai Group and how does that compare with what Tesla's doing. The context is that you had a very low valuation starting point, and at the same time, foundationally, there's investment happening.
You see that Rohit is pounding the table. Did you hear that?
There you go.
Rohit did that.
This is their time in the sun. Damien Sassower's been saying the same thing. Got time to really pay attention to emerging markets here. China, what is your world doing with China these days? For a while, it was almost uninvestable. Now it seems to be coming back. How do you guys think about it?
Yeah, so I think that the exciting thing about China is that there's no one China.
Okay.
It's no longer just purely based upon fixed asset investment and property development. That area is still quite challenged. But what's exciting is what China's doing in terms of energy security, what China's done in terms of AI, renewables, EVs, right. As we talked about, over 50% of vehicle sales in China today are EV. They're also exporting. So that context in terms of them moving towards right. the fourth industrialization. And at the same time, we've seen a lot of development, particularly around the AI, the natural language processing that's occurring, that China's also playing in that global race.
Rohit Chopra with us. He's EM Equity Portfolio Manager at Lazard Asset Management. Can we massively rip up the script?
Yeah, let it rip.
Okay, I'm going to editorialize and say that under the leadership of Peter Orszag, who's been way kind to me over the years, Mr. Orszag has reinvigorated the academics of Lazard. The brain power coming out of your shop is just jaw-dropping. Is AI transferable to the EM economies? I get it that AI works in Silicon Valley. It works at Northwestern in Chicago. Does it work at Duke? I think
sure,
it works at Duke.
Big time.
It works at Duke. Does it work in Malaysia?
It works because it is a tool right now. It's leading to productivity gains. It's about understanding the data. But what's also a fact is that AI will be highly disruptive as well. We're seeing some of those debate. For example, I just came back from India. There's a big debate, particularly in the IT services industry, where a lot of these companies were benefiting from lower cost labor and IT right. expertise. And now potentially that code is going to be written by AI, and that can be disruptive.
Okay, the heart of India is Satya Nadella coming out of Bangalore and down south. Is it Tamil Nadu. How are they adapting to AI in the heart of Indian technology?
Yeah, so it's a wake-up call. I think the first thing I'd say here is that if you look at Indian corporates, historically, they haven't invested as much in terms of R&D spend. So R&D spend in India has been relatively low. What you're finding with the tariff discussions, that there's been a whole focus on how do we improve our R&D spend, how do we improve our manufacturing capability. So there's definitely a sense of urgency. I do think these business models will change. But at the same time, as companies adopt AI, you need the Indian IT service companies to help push through that integration.
Get one more in here.
In the world of emerging markets equities, where do you guys see maybe the best value? Given now you have had some movement here.
I think the best value in emerging markets today is Brazil.
Brazil. Okay.
I think
Brazil.
Yes, you have the benefit of weaker dollar. You have strong commodity complex, inflation under control, and most importantly, real rates are amongst the highest in the world. Base interest rates at 15%. I think that starts to come down as inflation comes down, and that's going to start to drive a credit
right.
cycle. And that's going to be, I think, a big surprise to investors that they see growth improving there.
I got to go to research note that just came out. Rohit Chopra, thank you so much for coming in with Lazard. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Jennifer Welch joins us now, Chief Geoeconomics Analyst, Bloomberg Economics on Iran, and suddenly on Cuba. Jennifer Welch, thank you so much for joining us. It's 94 miles from Key West to the shores of Cuba. How close are we to Cuba as we go into the weekend?
I think at the moment, the situation is somewhat uncertain, but somewhat stable too. When we look at the recent incident of a Florida tag speedboat approaching Cuban authorities, having a crisis, a shooting incident, and the immediate response from Washington doesn't seem to indicate that the United States is looking to get directly involved at this moment. They're looking to gather more information, but it's somewhat of a de-escalatory step. I think the broader trajectory, though, of the relationship is increasingly negative for Cuba. The economic pressure campaign that the U.S. has put in place doesn't look like it's going to let up anytime soon, nor has the U.S. shifted its position and what it ultimately wants to achieve there.
I mean, Jennifer, I remember my parents hiding the newspapers of the Cuban Missile Crisis because they thought that, the offspring would be afraid of it. Go to 2021, Miguel Diaz-Canel takes over, not a Castro. Who is the leadership of Cuba that Secretary Rubio must confront?
It looks like Secretary Rubio and his team are engaging with a number of different elites, including the former leader's personal bodyguards and crew. I think, though, negotiations are still at a pretty nascent stage at this point, and this is likely to be an extenuated situation. I mean, if we think back to even Venezuela, that was a months-long pressure campaign and at much higher levels of intensity than what we're currently seeing right now. You mentioned earlier that there is also a situation in Iran and the Middle East. U.S. attention at the moment is a little bit more divided and spread across the world, and I think that's part of the reason that we're not seeing a huge escalation on Cuba right now.
You mentioned Iran. The U.S. is putting some serious military hardware in that part of the world. We typically don't do that unless we're going to use it, historically speaking. What's the latest thinking coming out of Washington as it relates to Iran?
The military buildup, as you mentioned, it's one of the largest in decades since the Iraq War, really, in many ways. And I think it serves two purposes. The first one is signaling power to Tehran that the United States is serious about wanting a deal and sort of applying this ongoing pressure. The second is to give the president options if he does decide to order strikes. Now, the risk that we face is the talks yesterday in Geneva didn't produce an immediate agreement. They are meant to continue next week, but U.S. negotiators reportedly left that meeting quite disappointed. And we've seen in the past, including last year, that President Trump ordered strikes on Iran even when talks were meant to continue. So we're by no means out of the woods yet on this situation.
What is really the strategy of the U.S. right now? Has that been articulated well by this White House?
Well, as we heard from the president earlier this week in the State of the Union, I think if you had to boil it down, his strategy is to try to get Iran to agree to a nuclear deal again. After pulling out of the nuclear deal that the Obama administration structured, the president is now aiming to negotiate a new deal with Iran. The challenge is that from Tehran's perspective, they already agreed to a deal and the U.S. is the one that reneged on it. And now the U.S. is asking for far more at a time in which Tehran feels it has far fewer options and its back is already up against the wall. So this is a really tense situation.
Jennifer, we got to go to breaking news, but really appreciate the 24/7 you've been doing. She is Chief Geoeconomics Analyst for Bloomberg Economics, Jennifer Welch here, and I think we'll be more than speaking to her in the coming weeks here, particularly on Iran.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.